Forwards. A forward contract or a forward is a non-standardized contract between two parties to buy or sell an asset at a specified future time at a price agreed upon today. The party agreeing to buy the underlying asset in the future is said to have a long position, and the party agreeing to sell the asset has a short position. The forward price agreed upon by the two parties is called the delivery price. Forwards are used to hedge risk mostly. It can be used for speculative purposes too. In the commodities market, it is used to take the advantage of the quality of the commodity as well. The payoff of a forward contract for the two parties at maturity is, for a long position, this payoff is Ft is equal to St minus K. For a short position, this payoff is Ft is equal to K minus St, where St is the price of the underlying at the maturity of the contract and K is the delivery price. The link between the spot and forward market can be established on the basis of spot-forward parity. It also enables to infer the relationship between the two prices of the underlying. The concept of cost of carry can be applied to develop a relationship between the two. But this effect can be broken down into different components on the basis of the asset as follows. A discrete or a continuous stream of income is paid by the asset. Storage costs are incurred. Convenience of holding that asset. For an asset to provide no income, the relationship between the current forward F0 and spot S0 prices is current forward price is equal to current asset price into e raised to the power RT, where R is the continuously compounded risk-free rate of return and T is the time to maturity. The logic behind this relationship comes from no arbitrage. It means that if one wants to have an asset like gold at time t, then there should be no difference in buying the asset today and holding it till that time or buying a forward contract. For an asset that pays no income, the relationship becomes discrete. Current forward price is equal to current asset price minus I into e raised to the power RT. Continuous. Current forward price is equal to current asset price into e raised to the power R minus Q into T, where I is the present value of the discrete income at time t0 less than t, and Q% per annum is the continuously compounded dividend yield over the life of the contract. The intuition behind this is that since holding the asset is more profitable than holding a forward, the income that one generates from possessing the asset should be reduced from the price that has to be paid for a forward. For commodities such as gold and silver, one incurs a cost to store them after acquiring them physically. Storage costs are an outflow for the owner of the asset, and hence they can be treated as negative income. The relationship with storage costs is as follows. Discrete. Current forward price is equal to current asset price plus U into e raised to the power RT. Continuous. Current forward price is equal to current asset price into e raised to the power R plus U into T, where U is the present value of the discrete storage cost at time t0 less than t, and U% per annum is the continuously compounded storage cost where it is proportional to the price of the commodity. The logic that plays here is that it becomes less attractive for a person to buy the asset now and hold it till maturity unless he is compensated for the costs incurred by him. The relationship between spot and forward prices can be established by deducting all streams of inflows due to the asset and adding back of all the costs incurred to maintain parity with forwards. Thus, all of the costs and benefits above can be summarized as the cost of carry, C. Hence, discrete, current forward price is equal to current asset price plus U minus I into e raised to the power r minus y into t. Continuous. Current forward price is equal to current asset price into e raised to the power ct, where c is equal to r minus q plus u minus y, where y% per annum is the convenience yield over the life of the contract. The situation where the price of the forward is more than the expected future spot price is known as contango. When the price of the forward is less than the expected future spot price, it is known as normal backwardation. Futures. A futures contract is a standardized contract between two parties to buy or sell a specified asset of standardized quantity and quality for a price agreed upon today, the futures price, with delivery and payment occurring at a specified future date, the delivery date. Futures are exchange-traded instruments. One of the advantages of entering into a futures contract over forward is that the counterparty risk is less. The exchange ensures that the credit risk of both the parties is kept to a minimum. The exchange requires both parties to put up an initial amount of cash, the initial margin. Additionally, on a daily basis, depending upon the movement of the price of the underlying asset, the exchange settles the accounts of both parties by transferring money from one account to the other. If the margin of a party falls below a certain level, maintenance margin, the party has to replenish the account. This process is known as marking to market. Futures contract can be settled in two ways. Physical delivery. The amount specified of the underlying asset of the contract is delivered by the seller of the contract to the exchange and by the exchange to the buyers of the contract. Cash settlement. A cash payment is made based on the underlying reference rate, such as a short-term interest rate index, such as 91 days T-bills, or the closing value of a stock market index. The price of a forward and a future of the same commodity will be same in the case of constant interest rates and also when the underlying asset has no relationship with interest rates. Otherwise, the difference between the price of the future, futures price, and forward price of the asset is proportional to the covariance between the underlying asset price and interest rates. For example, a future on a zero-coupon bond will have a futures price lower than the forward price. This is called the futures convexity correction. Thus, assuming constant rates for a simple non-dividend paying asset, the value of the future and/or forward price, FTT, will be found by compounding the present value, ST, at time t to mature TT by the rate of the risk-free return, R. Discrete. FTT is equal to ST into 1 plus R raised to the power t minus t. Continuous. FTT is equal to ST into e raised to the power R into t minus t. The main differences between forwards and futures are as follows.